Hello everyone. Please let me know if you can hear me. Give me a sign that you are there. Hello everybody. Today is Friday, the 7th of November, and I'm waiting for a sign that you can hear me and that you can see my screen and that I am streaming. Thank you, Marcus. Good evening to you as well. Hong Kong here. That's wonderful. Thank you. And good morning from Los Angeles, Angela. Good morning from Germany. All right, so I'm glad that you are all here. Thank you so much for being with me on a Friday. Well, for some of you, Friday morning. For me, it's a Friday evening. It is 6 o'clock here in Germany at the moment. And we have spoken for 4 days, for quite a few hours, about the wave principle. I've introduced to you pretty much all the elements of the wave principle. So today we're going to fill in the gaps everywhere, every part that we didn't mention, and even more. I trade futures on lower time frames, such as 1 to 5 minutes. Can Elliott give me guidance so that I can better estimate the probability of the direction? Well, certainly. It's going to be very difficult for you because you have chosen a very, very difficult life. Trading off 1 minute or 5 minute charts is probably the most difficult thing for a trader. But the Elliott wave principle is fractal. So certainly, everything we have spoken, everything we have learned, applied, etc., is exactly the same for a 1 minute chart, for 2 minute chart, for 3 minute chart. It doesn't really matter. So statistically, day traders lose money. Statistically, you have all the odds against you. Typically, when somebody says that, we always think, well, no, my case is different. But, you know, these are research that have been run for decades, and they always come up with the exact same conclusion. Day traders lose. Their mission is to provide liquidity to the markets, but they don't make money. And when they do, that very tiny, incy-wincy percentage of traders that do make money day trading, they make something similar or the equivalent to a minimum salary, but with the added stress. Okay, so it said here, I tried 1 minute, I lost it. Sorry about that. Let me see if I can get it back. Sometimes for me it's difficult to observe the Elliott wave, the Elliott triple combos. Okay, we'll discuss that today. Yes, I'm sorry I missed the other messages, but let's get to it. You know, we discussed motive waves and corrective waves. Those were the two modalities, right? Motive waves move in the direction of the main energy, of the main trend. Corrective waves move in the opposite direction. Motive waves are divided into two types, that is, impulses and diagonals. Impulses and diagonals both subdivide into 5 waves that we label with numbers. And impulses must follow the 3 rules for impulses. That is to say, wave 2 can never retrace more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest, and wave 4 can never enter the price territory of wave 1. Whereas diagonals don't follow those rules precisely. Diagonals follow different rules, the rules of motive waves in general. And those are: wave 2 can never travel more than 100% distance traveled by wave 1. Wave 3 always moves beyond the end of wave 1. And wave 4 never travels beyond the end of wave 2. Those are the 3 rules of motive waves. And those are the rules that diagonals must follow in order to be diagonals. So we discussed diagonals, and we said that, well, the subdivisions of the diagonals are not of 5 waves each leg that go in the direction of the trend, but they subdivide into zigzags, into 3 that take the shape of a zigzag. They take the shape of a corrective structure, yet they move in the direction of the trend. And, well, that is the main difference. And the other main difference is that wave 4 actually ends in the price territory of wave 1. And not only is allowed in diagonals, but is expected to do so. And we also said that diagonals typically appear at the end of an impulse. In other words, it takes the position of a wave 5. So far, so good. Now, today I want to show you a structure that also appears in the market very often, many times, and that we didn't draw. And I want to show you that if we were to count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So if we were to count that, we would have 15 waves. Yet, if we only see the main direction here, where we stop here, that would be 1, 2, 3, 4, and 5. Exactly as it would happen in a diagonal. So what makes this different from a diagonal? Well, when we drew a diagonal before, we did something like this, where wave 1 was like this, wave 2 was like this, wave 3 was smaller than wave 1, wave 4 was like this, and wave 5 typically smaller than wave 3. And so then we used trend lines to connect the end of wave 1 with the end of wave 3, and the end of wave 2 with the end of wave 4. And then that produced that wedge shape that characterizes the diagonals. But if we were to do the same here, we would have to connect wave 1 and 3 and wave 2 and 4, and we would see that that wedge is not there. In fact, it's not contracting like in this case, it's actually expanding. It takes that famous shape of traditional technical analysis pattern called the megaphone. So this is what most people know as a megaphone. And what is a megaphone? Well, a megaphone is actually a diagonal that we label exactly as a diagonal, wave 1, 2, 3, 4, and 5. And the difference with the normal diagonal is that it expands. Therefore, it is called an expanding diagonal. No other difference than in function than the contracting diagonal. Now, there are some differences in the shape, in the way they look, right? Because in expanding diagonals, you would expect that wave 3 be longer than wave 1, and obviously wave 5 be longer than wave 3. Wave 4 would be longer than wave 2. And that's what it gives it that shape, the megaphone shape. Whereas in in the contracting diagonals is pretty much the opposite. Therefore, it looks contracting, not expanding, right? The contracting, the wave 1 would be the biggest one. Wave 2 would be smaller than wave 1. Wave 3 would be smaller than wave 1. Wave 4 would be smaller than wave 2. And wave 5 would be smaller than wave 5. And then, of course, there we would have the beautiful shape that looks pretty much like a triangle. If you remember that we mentioned that, it looks pretty much like a triangle, but a triangle with direction, a triangle that is moving in the direction of the trend, in this case, up. And the difference between this and the triangle was that the triangle as a corrective structure doesn't make progress. It doesn't move in the direction of the trend, it's sideways. So, therefore, we call them with different names. This is a contracting ending diagonal, and the other one that was expanding, the megaphone, is called an expanding ending diagonal. And the same thing that we did in I believe in the last class, where we substituted the wave 5 for a diagonal, can be applied here. This is wave 1, 2, wave 3, wave 4, and then it can apply here for a wave 5 with a an expanding diagonal. It's exactly the same way, and expectations are pretty much the same, which I'm going to tell you now, because we didn't speak about the expectations of a diagonal before. The reason, because I didn't want to over saturate you with information. So you can see here we have, let's label this like this: wave 1, 2, 3, 4, and 5. And these 5 waves here, that would be the internals of this one, which are minute, I believe, right? Let's see. These are minute. So now we need to use minuet. So let's see. 1, 2, 3, 4, and 5. And then we change the degree to minuet as to identify the difference in degree, that they are the components of the 5 in circle. So this one will be the 5 in parentheses. Now, what are the expectations of a diagonal, being a megaphone or a contracting diagonal, regardless? Well, as I said, if they appear at the end of the structure, that means the 5th wave, well, that means that we expect prices to move in the opposite direction, obviously. Now, the question is, how much, to what degree, how fast? And this is what we want to keep in mind. Whenever we have this, we expect prices to actually collapse. In other words, every time there is a diagonal, we want to see prices moving in the opposite direction at half the speed that took the diagonal to form in order to go to the origin of the structure. In other words, prices originated from here, right, to go to the diagonal, and let's say that this took, 3 months, okay, let's say 4 months to make it easier. So we expect that the decline now to get to the origin of the diagonal would take 2 months. Now let's say that this is an hourly chart and the diagonal formed in 4 hours. Well, the decline then would take 2 hours to get all the way here. That means that when we identify a diagonal, we actually want to participate in that move because we know that that move is going to be fast. It's going to deliver rewards very quickly. And likely it's not going to be giving us some moves in the opposite direction. And we expect that the target for that trade would be precisely the force of one lesser degree. And the reason is because, well, that's the origin of the diagonal. It's too much to ask to show a basic current count on something like BTC today before closing. We can look at BTC. Yeah, sure, we can look at BTC, no problem. But for sure, I'm not going to be taking, requests from different markets, because we'll never go through the educational program, which is the intention of this. But we can do the Bitcoin. All right, so here we have a diagonal that appear at the end of the structure, and it's called an ending diagonal. Of what type in this case? Well, of an expanding ending diagonal. And now we know the consequences of it. And these are very important consequences to keep in mind. And the reason is because these are very applicable things for our trading. Now, diagonals can also be, diagonals can also be leading. What that means is that we can see that sometimes the diagonals take the place of wave 1. This is less common than the ending diagonal, but this also occurs. So this would be wave 3, wave 4, and wave 5. So again, we would see here the 5 legs of the 1, 2, 3, 4, and 5, and now we can connect the 1 and 3 and the 2 and 4, and now we have our wave 1 of a higher degree, right? So let's change it here so we don't get confused. This would be the higher degree, in this case minute. So this goes here, the 1 here, the 2 would be here, this would be the 3rd, the 4th, and the 5th. So now notice that, well, we still have an impulse there, and that impulse still must follow the rules. In other words, wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 can never be the shortest, and wave 4 can never end in the price territory of wave 1. All those rules have been followed in this drawing. Therefore, this qualifies as an impulse, but it's an impulse that the first leg took the shape of a diagonal instead of the shape of an impulse itself, as we have been discussing for such a long time. We're saying that all actionary waves of an impulse are motive waves. Actually, that was the wording I used, right? But sometimes I said are impulses, just to set in your mind the idea of impulses moving in 5 and so forth. But the rule is that all the actionary waves, meaning wave 1, wave 3, and wave 5, the waves that move in the direction of the trend, actionary waves, must be motives, whether they are leading diagonals, ending diagonals, or impulses, but they must be motive. Now, the thing to keep here in mind and never forget is that diagonals can be leading and can be ending, but they cannot be middle. In other words, wave 3s can never take the shape of a diagonal. And, well, the reasons are obvious. Wave 3s, as I explained before, they are called the wonders of nature, right? And they are called the wonders of nature because they are typically the ones that accomplish the most in the shortest amount of time. If we were to expect a diagonal on something that is supposed to be so fast, well, we would be really contradicting ourselves, because the reason why this is not moving as fast is precisely because it's encountering opposition, and it's not able to develop into 5. So it develops only into 3. But the forces still push it to the upside, but keeps developing into 3 legs instead of 5. Therefore, we don't expect that something like that could happen on wave 3, because wave 3 is the strongest one. And why are wave 3s the strongest ones? Well, for one simple reason. By the time that wave 3s happen, the trend has been identified by most people. In other words, people have been seeing that there are highs and lows and higher highs and higher lows and higher highs and higher lows and higher highs and higher lows. And they are saying, the trend is up. Therefore, by the time that people see this wave 3, this is the moment where everybody wants to participate. This is the most popular phase of the trend. In fact, yesterday, let me see if I have it here. Yesterday, I spoke to you about the evolution of technical analysis and told you about the Dow theory and how Elliott came to refine the Dow theory. And so here, let me see if I have, here I have the Dow theory. I wanted to show you the Dow theory here because, well, here it is, the trend according to Dow. He divided the trends into primary, secondary, and minor. Primary trends last for more than a year and may extend for several years, so long as each successive rally reaches a higher level than the previous one, and each secondary reaction stops at a higher level than the previous reaction. But that's pretty much higher high, higher low, right? The Dow theory called this a bull market or an uptrend, which is precisely where the definition of an uptrend comes, higher high, higher lows. Now, conversely, with each decline carries prices to successively lower levels, and each recovery fails to bring them back up to the top level of the preceding rally. In other words, lower lows and lower highs again. And this is a bear market or a downtrend. So this is the way that he called the different phases. The first phase was accumulation. Second phase was the big move. The big move because everybody's participating here. And the third phase is the phase of excess. And when it is in a downtrend, well, the names change a little bit. The first phase is called distribution, the second phase is the big move, and the third phase is despair. But what this is basically the 5 legs, right? The accumulation, the big move, and the last leg here, but it didn't connect it, right? So because those were the secondary trends. So what we are seeing here are the primary trends that should divide into 3 phases. Okay, so now let me see. Let me not miss too many of your comments because I see many. It's too much. Yeah, we saw that. Elliott wave diagonals seem very close to what traditional technical analysis labels as rising and falling wedge. Yes, exactly. That's what I have been telling you about the wedge shapes. All right. So now here's another thing. Is it possible that you encounter a wave where wave 1 is a leading diagonal and wave 5 is an ending diagonal? And the answer is yes. And why? Well, because there are no rules that say 2 diagonals cannot appear on an impulse. Yes? So sometimes you could find a leading diagonal 1, wave 2, wave 3, wave 4, and an ending diagonal 5. And this could be a contracting diagonal, this could be an expanding diagonal, or this could be an expanding diagonal, and the fifth wave could be a contracting diagonal, or this could be an expanding diagonal, and the wave also an expanding diagonal. It doesn't matter. They are all possibilities. So let me see. Cat JPY is in a diagonal, maybe. I haven't checked it. After yesterday's session, I got motivated and went to the book for revision, Elliott Wave Principle by Frost and Prechter. What I read there is confusing. Well, yes, very confusing. I told you that from the beginning. I mean, people try to learn the wave principle using books, and that's the main book basically, because the other books that are out there for the wave principle, they don't work at all. Some actually contradict completely what the wave principle is, and it doesn't even relate to what Elliott taught. Some of those books, for instance, there is one famous one by Glenn Neely. It's a book about the wave principle that has nothing to do with the wave principle. So yes, when people try to learn the wave principle via books, especially the first book, it's extremely confusing. I tell you, one of the greatest confusions that they promote is that they call this a triangle. I changed the name of a triangle, because if you call a triangle a correction and you call a motive wave a triangle too, you can actually be very confused. At least I was. And as I mentioned before, it took me 7 years to learn this stuff and become clear with it. But it wasn't easy because, well, I was very confused, particularly with that business with the triangles. There were leading diagonal triangles, leading contracting triangles, and there were horizontal triangles, and there were contracting triangles, running triangles. There were all kinds of triangles, and they were all having different functions, whereas the whole thing is so much simple or simpler when we say triangles are corrective structures, period. The rest are diagonals, and they are either leading or ending. And, well, they could expand or contract, but that doesn't change anything. It's very easy to remember. Diagonals are part of an impulse. They are part of a motive wave. So, yeah, sorry that the book is confusing, but it is absolutely true. I got so confused with that book. It took me forever. A diagonal is the only 5-wave structure in the direction of the main trend within which wave 4 almost always move into the price territory of wave 1. Yes, that's exactly what I mentioned before. Not only the wave 4 actually is allowed to, but it's expected to. If we see a diagonal, or what we think is a diagonal, and wave 4 is not inside wave 1, even deep inside wave 1, you probably have reasons to doubt that that is a diagonal. That's why I said it's expected. Okay, so let's see what else we have here. Waves are threes, producing an overall count of 3, 3, 3, 3, 3. The usage of words almost always. So it doesn't mean it should always move in the territory of wave 1, right? Not according to the book. But that book was written in 1976, and the Elliott Wave Principle has been in continuous development. So at this point, I will tell you, if you see a diagonal where wave 4 is not inside wave 1, you probably don't have a diagonal. Let's see. Can I conclude? These are just guidelines, not rules. I can only expect it as one possibility. A small variation is okay. Can you please share your opinion? Yes, you are absolutely correct. The rules are very, very specific. And those were not rules. Those were guidelines. But I must bring to your attention that when Elliott wrote the wave principle, he actually had more rules that he himself, with time, realized they couldn't be rules. Not going to mention them now because we'll bring more information that may confuse you. But the point is that, as I said, he made some observations. He thought this is going to be a rule. He thought this is going to be a guideline, and then realized, couldn't be a rule because it not always happened. And when it is a rule, it must always happen. When it's a guideline, it may or may not happen. So those are something that had evolved. And now we have 11 rules for motive waves, and they are very, very, very specific. And I have given you so far the most important ones that you need to learn and keep in mind. When you say after contracting or expanding diagonal, we should expect the price to collapse very fast, but it is not the case after the wave 1 in your picture. That is correct, because that is not an ending diagonal. That applies only to the ending diagonal. And the example I gave you was with an ending diagonal and told you that prices will take half the time that took to form to get to the origin of it, which was wave 4. There is no wave 4 here. So we never said to get to wave 0 because that doesn't happen in leading diagonals. In fact, this is something that, well, maybe it's not in any book either. This is something that I have observed with decades of using the wave principle, and that is that leading diagonals in currencies tend to produce very shallow wave 2s. In other words, you would expect a wave 2 typically to retrace at least half the way of wave 1, right? But with leading diagonals, it doesn't happen. So, and that's something that I have observed only in currencies, not necessarily in stocks, or other markets, but in currencies particularly, it happens that wave 2s don't develop deep when they are preceded by a leading diagonal. With your experience, what's the symbol or group of symbols that have better returns with a lead wave? All of them. Absolutely no difference. No difference whatsoever. And no difference in market. You can trade indices, you can trade... Actually, to be honest, when I see a chart, I see a chart. I don't see a market. I don't care about the ticker. I don't care about the time frame either. All you see is a chart with a bunch of bars that form a particular pattern. Now, that could be a real estate market. Doesn't matter. The chart is a chart and it forms the patterns exactly the same, as long as, of course, as we are speaking about collective psychology. In other words, many participants must take part in that market to produce those patterns, because the Elliott wave principle, at the end of the day, is a study of psychology. This is basically what Elliott observed here, is how mass psychology behave. If you ask ChatGPT, it even says wave 4 cannot enter wave 1 at all. But from your notes, it can, but should not close. ChatGPT, and I tell you this with enough experience, because I don't think there are many experts out there with Elliott waves, and I can count myself among those that are expert on Elliott wave, and I can tell you ChatGPT makes such a mess with Elliott wave that it's upsetting. You know, I have been asking ChatGPT about many things on Elliott waves, and it always gives me, and I would say probably 99% of the time, give me the wrong answer. So be careful with what you believe with ChatGPT. I said in the case of Elliott wave because it's the thing that I know the most. Now, if you ask something about medicine, perhaps it will give you the right answer. I don't know because I'm not a doctor, But I would tell you, be careful with what you ask ChatGPT, because at least with the materials that I know very well, I know that it's wrong. And perhaps it's because whoever programmed it was not very well versed in the subject. All right, so we have covered, I think, everything that we need to cover about diagonals. They're very, 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 very important structure, very important pattern. It's very important for you to know that they can appear in the beginning of the structure or at the end of the structure. They can take the shape of a contracting diagonal or an expanding diagonal. Now, we spoke about corrections. Just a second. Okay, so let's see. Do you recommend using Williams fractal to accurately mark the wave formation? I realize that it can be quite difficult sometimes to find the correct place to mark the waves. Everything with the Elliott wave principle, actually with everything, everything is practice. Everything depends on your training. Everything that you start learning is typically very, very difficult. After you practice it, it becomes simple, simpler, easier. And then you wonder, how is it possible I didn't see this before? It's funny, but it always happens. I have students that send me the chart that they labeled for me 6 months ago, and they cannot believe what they see, what they made. How is it possible they couldn't see, right? So it's like your eyes get open and more open, and your brain learns to recognize those patterns. And yes, there is a part of the brain that helps you identify the patterns, and then you start seeing them more often. And well, when you haven't been taught the pattern, then of course you cannot see them. So what I do recommend is that you take many charts and label them, and then first take them historically. In other words, don't try to forecast at once, but take them first. How would you explain this move? And then thereafter, with time, then you start using them in real time. Do you use any Elliott wave indicator, or you just find and draw the waves manually? I don't use any indicator for the Elliott wave, and I would tell you, I would advise you strongly never to use one. That doesn't mean that I'm saying they are terrible, but in my experience, I have used them many times. I have tested them, not used them, tested them with different platforms, some of the best platforms out there. They don't work, ever. So don't try to use them. All right. Can diagonal happen in corrective patterns? Yes, they can. In any corrective pattern where one of the components is a 5 wave, is a motive wave, such as in the zigzag. Remember the zigzag? We said the zigzag moves in 5 waves, and then 3 waves, and then 5 more waves. So if we have a 5-3-5, a leading diagonal can take the place of wave A, and an ending diagonal can take the place of wave C, right? So indeed, any place where the end is a 5-way move could be done via an ending diagonal. So now let's review a little bit the corrective structures. We discussed the zigzag, and we discussed the flat, and we said not much different from the zigzag, except that wave B retraces all the way to the origin of wave A. And we discussed the triangle A, B, C, D, and E. We used formulas for all of them. In the case of a triangle, all of the legs are zigzags. In other words, they are all 3, 3, 3, 3, 3. In other words, 3 times 5. Right? So 3, 3, 3, 3, 3. In the case of a zigzag, well, we mentioned the formula is 5, 3 for wave B, and 5 for wave C. And in the case of a flat, we had the formula 3 for wave A, 3 for wave B, and 5 for wave C. Meaning that this wave here could take the shape of an ending diagonal. And we also discussed, but not in details, we discussed that they all have variations. So what we're going to do now is to look at some of those variations. Okay, so let me erase this and keep the originals up there so you can see how they vary. Let's begin with the flat. As you can see, the flat wave B goes to the origin of wave A, but sometimes it simply goes above it. And, well, it's still a flat. It's only called an expanded flat. It's expanded because it went beyond. I must say that this flat, even though it's not the most regular one when we discuss them, this is the most common flat. It's, well, the one that serves as a trap for traders, because if you have, let's say, wave 1 here, yeah, and now wave 2 here. Wave 2 went above the end of wave 1 and then trapped trader thinking that the trend was going to continue, and boom, it falls in 5 waves. So these are traps. Therefore, they are the ones that occur most often. Ricky Pimping, do you utilize... Oh, I'm sorry, that's not for me. I think you probably were trying to send a private message or something like that. Now, there is another variation of this expanded flat in which prices in wave B go again above the origin of wave A, but when they come back in wave C, they are unable to move beyond the end of wave A. So they form this shape. So we have A, B, and C, but C doesn't manage to go here. Why? Because prices are really in a hurry. So what this means is precisely that. If you have a wave 1 here, and then you have a wave 2 that took the shape of a flat of this type, is called a running flat. Maybe you can remember that it's because it's running. And that means that wave 3 is going to be really fast and strong because, well, prices could not even manage to go below the end of wave A. So whenever you see a running flat, you know that you better hurry because wave 3 is happening very strongly, very fast, maybe for some sort of news or something. So these are the variations of the flat family. These are all the flats that you can find. The regular flat or flat simply, the expanded flat that move above the origin of A, and the running flat that was so much in a hurry that couldn't go beyond the end of wave A. You said that it took 7 years to learn Elliott wave. With what strategies or indicators you traded before applying Elliott waves? Uh, you are exposing me. I'm going to answer that and say this with the uh, utmost um, humility that I'm forced to collect. I spent 7 years trying to trade and losing money because I was trying to trade with the wave principle and not understanding it. Obviously, I was learning technical analysis in general, but I saw the potential of Elliott waves because technical analysis, as I discussed from the beginning, is something that, if not done in the context of Elliott wave, is very hard. I mean, there are certain things that are extremely powerful in the context of technical analysis without the Elliott wave principle. But to me, everything made sense when the entire analysis was painted on the canvas of the Elliott wave principle. So when I knew the direction of the trend and how to identify the trend properly, not with that higher highs and higher lows, then everything else in technical analysis made sense. So the first 7 years, yes, I spent a fortune and lost another fortune. And when I mean I lost another fortune, I mean it. I lost a lot of money trading for many, many years. Yeah, so no, I I wasn't very, very talented for this. You know, you have to understand I was a musician, right? I had never been exposed to anything that had to do with markets, with finances. All I did was to play concert. I was a classical concert musician. So all I did was to travel from country to country, play in theaters with orchestras, whatever, and come back home, practice more, and go back and play another concert. So I had no exposure to any of this. But at some point, my father-in-law asked me about my investment, and I was very embarrassed to admit that I had no investment because I never thought about it. You know, I was, as I said, I was a musician. All I did was to play concerts and think of music and concerts. And that happened ever since I was a very, very young boy, because I grew up as a child prodigy in music. So I was playing concerts when I was 15 years of age. And when I was 17 years of age, I became a professor at the university. I was the youngest professor at the university. And ever since, I was a professor at many universities and colleges and music hochschules and conservatories and so forth, all over the world. And so I never learned anything to do with, with investment or anything like that. And so I was not talented for this, but since I had grown up as a child prodigy, I thought that I could do whatever and, get away with it. And, that's why I started doing this. And I thought I was going to make a killing, and I didn't. It almost killed me. Yes, very, very embarrassing to admit it, but yes, it took me years. All right, I have seen that play out in backtesting quite a bit, where in an ABC, C doesn't get below B. That's correct. That happens very often. It's a very, very common pattern. I lost a lot too, almost bankrupt, and not Elliott wave. So, same here. Well, sorry, I laugh. It's just because when you say same here, it's like, yes, I have been there. And you and I and many more. There are very few people. I have many students actually that have managed to escape the fate of all traders, which lose money for decades or at least for years before they give up. But the normal trader lose money for several years. You have an amazing story. Thank you for sharing. Oh, thank you for asking and considering it important, Angela. I never tell the story because, who cares about me? Do you use any scanner to find stocks that for Elliott Wave? You can. I don't have anything against that. You can use scanners and you can actually use the typical scanners that people use. For instance, prices are above the 200 moving average, or that where the RSI is above the 50, or whatever type of filters you can use them, and then make the analysis, the Elliott wave analysis, and then make the decision, the proper decision. All right, let me continue here with the variations of the triangle. So the triangle, well, this is the contracting triangle, right, where we put the lines like this. And I mentioned before that there is a possibility where wave B moves beyond the end of the origin of wave A, exactly as in a running flat, exactly, right? And then the rest of the triangle is the same. And the shape of the contracting triangle is exactly the same. So this part, the beginning, is exactly the same. So because this formula 3 and 3 is exactly here 3 and 3, because all the legs here are 3, 3, 3, 3, 3, right? So here we have 3, 3, and here 5. So when these start developing, we don't know if this is going to be a running flat, an expanded flat, or a triangle. It may turn to be any of the above. All right, so let me move on to a different topic, unless you have questions about the different variations of the corrections, or the basic corrections. I will give you one of the zigzag that I missed. Typically we say A, B, C, right? Let me write it, A, B, and C. Now sometimes, let's say that we have a very big leg, and sometimes this doesn't satisfy the needs for the depth of the correction. So a deeper correction is needed, and instead of making one zigzag, prices produce two zigzags. They are both ABCs, right? So the question is, well, what happened in between? Well, in between, there is an extra leg there. That is typically corrective, right? And so we have a correction here that is called a wave X. So now we have ABC, X, ABC. And this, because we have a zigzag here, connected by an X to another zigzag, we call it a double zigzag. So we have here a double zigzag. And sometimes we have another connector there as an X and have a triple zigzag, another ABC down. And this happens when there is a need for a deep correction that the first zigzag could not accomplish. Maybe I should make a better drawing and say this is a wave 3, okay? And then we see a zigzag there as a wave 4. But in wave 4 we don't expect it to be that small. Then we can probably think that it's going to be probably a double zigzag, or even a triple zigzag, and then achieve a level of depth of correction that is satisfactory for a wave 4. And precisely that's what I want to talk about now, which is what are the levels that we expect for wave 1, 2, 3, 4, and 5. And that is what somebody asked me before about Fibonacci. I want to use the most basic Fibonacci uses here, so you can have something that is really practical. Typically, all the waves relate to each other by a Fibonacci ratio. We expect that wave 2s retrace approximately 0.618 of the distance traveled by wave 1. Let's say 62%, so we don't make it so complex. So typically wave 2s retrace 62% of the distance of wave 1. This is the most common retracement that we see in waves 2s. In wave 3s, well, wave 3s varies a lot, but they typically relate to wave 1 with a Fibonacci multiple. People say that, well, wave 3s typically travel 1.618 the distance traveled by wave 1. That is not true, but it is not false. The using of 1.618 is a very good practice because we expect that wave 3 would travel a very minimum of a 1.618 of wave 1. Now that's not a rule. It could travel the same distance and be equal as long as it's not smaller. Remember that wave 3 can never be the shortest. Well, could be the same. It could be 1.236, it could be 1.382, or it could be 1.618, but it could also be 2.0 or 2.618. It doesn't really matter because there is no rule for that. Now, the typical expectations that we all have is to see it traveling 1.618 because it typically travels beyond the length of wave 1. And I will tell you how to actually project a wave 3 properly. And then wave 4 typically travels 38% the distance traveled by wave 3. Okay? And finally, wave 5 typically relates to wave 1. Okay? By a Fibonacci ratio. Wave 5s are either equal to wave 1, pretty much equal, like this exact same distance, or they are 0.618 of wave 1, or they are 1.236 of wave 1, or 1.618 of wave 1. It doesn't really matter. They are related to wave 1 by a Fibonacci ratio. So again, let's make a summary. Wave 2 retrace 62%. They can retrace also 50%. It's very common to have them retrace 50%. But the 50% is not really a Fibonacci number. So when we say a Fibonacci ratio, well, it's 62%. But in practical applications, we see that wave 2s often find support at the 50 to 62%. And that, by the way, gives us the possibility to create a very simple strategy, a very simple approach to trading with the wave principle, which is if we see 5 waves up, right? Now we expect 3 waves down. Now, where do they stop, right? Many of you have asked me that question, and there are many ways to answer this. But, well, you would expect that you use the Fibonacci retracement tool, and you would expect, you see, even when I made the drawing, it typically goes to the 50%. You see, this is the 50%. So you would expect that prices would retrace 50 to 62%. So very often you would see in my charts that I put a rectangle here where I expect prices to move down to, and where I expect prices to be rejected from to go to the next wave. So what is the strategy that you could all apply? Because you never know if prices are going to go from the 50% or from the 62%. So what you could do is to always trade half of your position at 50% and the other half at 62% with stop below the origin of wave 1. What is the typical depth of correction 1, 2, 3, 4, 5 Fibonacci? That's exactly what we are discussing now. Perhaps you wrote that question before I made the explanation. I joined Thai last year. Congratulations. I'm glad that you are in Thai. Have been still losing money, but Elliott wave study with Professor Aldo was a game changer. Oh, wonderful. I'm a medical professional and don't get much time to be in front of the charts. Oh, I will always be grateful to Aldo, sir, and the Technical Analysis Institute. Thank you very much. I hope that you are not losing money anymore. You said that you had been losing money consistently, right? But Elliott wave gave you made a game changer. That's great. Thank you very much for writing that there, Miral. Thank you. Okay, so what would be the strategy? Half of the position at 50, half at 62%, stop below the origin of wave 1, where you expect prices to be invalidated. Should prices go below there, you know that you're in the wrong position. So don't risk any more than this. Now, listen to this. If you risk, let's say, 40% here, well, it would be 38%, but let's say 40%. If you risk 40% here, or even 50%, this would be your risk. But your reward would be 1.618 of this, right? As I said, as a very minimum. And that is only if you exit the position or positions by wave 3. But you could stay in the entire structure and go to wave 5. In fact, you could even add on wave 4. So this is one of the most typical strategies that one can use because, well, it's very simple. It's a simple methodology, half 50, half 62, and then you know exactly where to put your stop. And yeah, very easy. So wave 2, 62%, or let's say 50 to 62%. Then wave 4 are very consistent. They are really, really extremely consistent and retracing to 38%. And when you want to trade wave 5s, and remember that I mentioned yesterday, you want to trade wave 3s and you want to trade wave 5s. When you want to trade wave 5s, well, you can put your entire position at the 38%. And yes, while your stop should be at the level of the previous one, at the peak of 1, you could pretty much reduce your risk by raising your stop to the 62% of the distance traveled by wave 3. And the reason is because wave 4s are very consistent. They do not retrace more than 38%. They typically don't move to 50% and almost never retrace 62%. If they do, you have a very strong reason to think that that is not a wave 4. Okay, so now you know the retracements for wave 2s and wave 4s, and you know exactly what to target. I don't mean in terms of taking a trade in that direction and target the 62%, because we want to trade with the trend. That's why we identify 5 waves here, and now we are waiting for these 3 waves here. So that's why we plan our trades and trade our plans. We actually do this with enough time. We plan this, and sometimes, very often, we just place our order at the 50% and the second order at the 62%. So if we are trading the 5th, we place our order there at the 38%. Now the question is, well, but how about targets? Where do we exit the trades? And for that, we need something else. We need a lot more knowledge, right? So, and I'm going to share it with you. Let me go to a different chart here, because I had a chart here where I gave a class, and that is already there. Yeah, Okay, so here we have different waves, different ways to identify wave 5s. Now, why wave 5s? And you say, yeah, but what if I'm trading a wave 3? Well, if you are trading a wave 3, you want to target the wave 5 of 3. In other words, let's say you saw the 1, you bought the 50%, you bought the 60, the other half at 62%, and now you expect at least 1.618, right? But you know that this wave 3 is going to develop in 5 waves, correct? And these 5 waves, well, they have a wave 5. So all you have to do is to project this wave 5. And that would be the end of your wave 3. And the reason why I do this instead of trying to project wave 3s is because, in all honesty, wave 3s are all over the place. Sometimes they are 1.618, sometimes they are 1.236, sometimes they are 1.382, sometimes they are 2.0, sometimes they are 4.236. They are all over the place and they are unpredictable. You can never tell where that wave 3 is going to go because they are extremely strong, right? So let's learn to project wave 5s instead. And here we have several, maybe let's go through some of them. We have several possibilities. The first one is that wave 1 be equal to wave 5 or in Fibonacci ratio. Okay, what I'm going to do is I have this, let me try to make it bigger. I have this chart here already labeled, so let's use it to see those different possibilities. Wave 1 be equal to wave 5 or in Fibonacci ratio. Okay, so what we do, we use the Fibonacci extension tool. We measure wave 1, right? And then we project that from wave 4. And what you know, exactly that right there at the 2.618 of wave 1. Yeah, exactly. So you can see that it goes in Fibonacci ratio. And let's go for a moment here. This would be wave 1, A, B, C, and expanded flat. You notice how the wave B of the flat went above wave 1? That's because, as I said, this is an expanded flat, typically a trap, bull trap there. And then, okay, after that we have wave 2. And notice this. What does it remind you? You see all these overlaps? These are not precisely impulses, right? So this is a diagonal, a leading diagonal 1. 1, 2, 3, 4, 5. And then we have here a triangle for wave 3, for wave 4, A, B, C, D, E for wave 4, and then finally wave 5. I think the labels there should be easy for you. So then the second way to project a wave 5 is by looking at the 1.382 or 2.0 of wave 4. Let me explain what that is. Again, you take the Fibonacci tool, the Fibonacci extension tool. You measure wave 4 from the end of wave 4 to the beginning of wave 4, which is the end of wave 3. And then you go back to the beginning of wave 4, and there you have it, exactly at the level what you expected. In this case, what is that? The 2.0, which is exactly the top. See? So we have here this, either 1.382 or 2.0 of wave 4. In order to do that, you measure wave 4, and then you expect the 1.382 or the 2.0. We have another way to do it, which is wave 5 will be in Fibonacci proportion to the net travel of wave 1 through 3. Let's see what this means. Basically, you will be looking at from wave 1 through 3. So what is the net travel? You measure from the bottom of wave 1, okay, all the way to wave 3, to the end of wave 3. And then you project that from the end of wave 4, and you can see right there the 0.618 is very close to the top, very, very close. So you can see that projecting wave 5 is a very not secure thing, and we cannot say certainty because there is no certainty in the markets, but it's a very safe thing to do. It's something very reliable, something that we can do with enough confidence, because we know that one of these projections typically works. In fact, I could show you charts where I make projections in months in advance and how they work, and sometimes they work to the pip, to the tick. So another possibility is wave 4 divides the entire structure in the golden ratio. What do I mean by that? Well, that means, let me use a different, well, probably a different chart. Let's say, okay. Let's go back to this one. Let's say that we have 1, 2, 3, 4, and 5. All right? So what does it mean that wave 4 divides the entire structure in the golden ratio? What is the golden ratio? Well, that means that from the beginning, or the beginning of the structure here, from wave 1 to the end of 5, then wave 4 would be dividing this into 0.382 and 0.618. That is the golden ratio, right? The 100% here divided by 0.618 and 0.382, or backwards. It could be that the top portion is 0.618 and the bottom portion is 0.382. So that's another possibility to project wave 5. Let's say I have more questions here. 15 minutes LTF, don't know what LTF is, to enter 1 minute or 2 minutes. I don't, please don't give me those letters. I don't know what that means. Everything you teach in your channel is invaluable. Pure gold. Thank you so much. I'm glad you see it that way. I cannot thank you enough for the knowledge you are sharing. Thanks. I thank you for taking it seriously. I'm glad that you are taking not only the live streams that we are doing, but the content of the channel. Which time frames can be good for starting Elliott wave for 1 to 4 weeks swing trading? As I mentioned, I think in the last few sessions, I mentioned several times, we don't use one time frame. There is no way to just trade one time frame. You need to have context. These 5 waves that you see here, this could be the 5 waves of an A, B, and C, and then prices are going down because this was a correction. Or this could be the 1 of a new trend, or it could be the 3 of a trend. It could be the 5th of a trend, right? It could be an A of a zigzag or a C of a zigzag. You don't know what it is, so you need context. Without context, you will be pretty much half guessing. Therefore, you need to, and that's what I recommend. Again, as I explained before, this is pretty personal approach. I recommend to all my students to begin with monthly or weekly charts, and then move down to 2 days or daily charts, and then intraday charts, wherever you find the clearest pattern. That, of course, that makes sense within the context of the of the higher time frames. Okay, let's make an example. Let's say that in a monthly chart you find that, okay, let's say that prices are in a triangle in a monthly chart. Okay, all the legs of a triangle are zigzags, right? So now let's say that in the monthly chart we have the A, we have the B, and the C, and we are expecting the D. All right, so we are expecting in a monthly chart a zigzag to the upside. Well, if this is indeed correct, we should be looking at 5, 3, 5, right? Well, now we move to the weekly chart, and now let's sorry, I don't have a better way to draw. Now we go to the weekly chart, and then we see if we actually have something like this. Now, if we find something like this, we know that this is an A, not a 1, and that this is a B. And now we know that what we're expecting is a move equal to this one, right? So we know now that we're not expecting a 1.618 because this is not a wave 3, this is a wave C. And therefore it's part of a correction of a wave C of a triangle on the monthly chart. And so, okay, now let's say that now we move to the daily chart and start looking for the 50 to 62% here, so we can enter to the upside, right? And so let's say that the daily chart is already at the 62%. So now we know that this is a zigzag here on the daily, right? So it should be having something like 5, 3, 5. So now we use this context, this knowledge, to go to, well, maybe a 5-hour chart, a 4-hour chart, a 3-hour chart, whatever, where you can see these 5 waves. If you find these 5 waves, well, now you can go to a 1-hour chart and look for this 5th wave. Now you have something like this in the hourly chart. If you have those 5 waves, you know that this is going to be the end of these 5 waves of these, which is, this would be the hourly, let's say, to the end of the zigzag in the 4-hour chart, let's say, which is the end of the zigzag that brought prices to the 62%, which is going to give you the entry, the refined entry. So which time frame you enter here? The monthly? Because we thought that now we are going to go to wave C? No. But we use the monthly for context. We are using the 60-minute chart. And of course, you can use the same thing that I'm saying from monthly to hourly. You can say, well, the triangle was on the daily chart, and the zigzag was on the 4-hour chart, and the other was on the 30-minute chart, and then you enter on a 10-minute chart. It doesn't really matter. What matters is that they are related, and they have the context of where they are in the entire position of the trend. I hope that makes sense. It's complicated a little bit, no? I mean, combo time frames, there is no such a thing. You are permanently combining time frames. Of course, if you are not using Elliott waves, if you want to trade with indicators and stuff like that, sure, you can use dual time frames, triple time frames. There are many techniques for doing things like that. High time frame, is it higher time frame for context, lower time frames to enter? Yeah, but not only with two. If you are using a dual time frame for any, let me put it this way. Let's say that this is a 60-minute chart, right? And this is what you are looking in a 60-minute chart. Well, if you are, let's say, in this part of the trend where this is 1, 2, now we expect a 3, 4, 5 of this, right? And then you put a trend line there. Okay, so this was a 60-minute chart. So now what do we expect? We probably go to a 15-minute chart, and we're going to take buy signals. What kind of buy signals? Well, whatever buy signals. I mean, in the channel you can find all kind of signals there. What kind? Well, you have stochastics, RSIs, you have MACDs, you have I don't know. There are so many channels. You have combination. You have indicators. You have so many possibilities to enter whatever signal you use. I mean, there is nothing wrong with your signals. Let me put it this way. Whatever signal you use is fine. All you need to add is a context, right? Now, if within that context, what you are adding is, what is the trend in Elliott wave perspective? Well, your winning ratio will multiply exponentially. And I don't mean it by a little. I mean exponentially, truly. When I tell you that, I mean your life as a trader will change completely, because now you're going to trade with the knowledge of where you are in the trend and what you can expect. And so that makes a completely different psychology. Now the psychology of us Elliottians as traders is completely different, because we know we are not going to have a crystal ball that will tell us where the market is going to go. There is no such a thing. What we have is a system that transforms a sea of possibilities, an ocean of possibilities, into a handful of probabilities. And within those probabilities, now we can use all kinds of indications, signals, etc., to take the trade, take the positions with the highest edge on our side. We multiply the odds tremendously. Now we are not gambling. We are not going there to see, this sea of possibilities that we have in front of us, they are so overwhelming that if you don't know where to put them, how to frame them, you're going to be gambling. But if you have a system that helps you frame that and transform that ocean of possibilities into a handful of probabilities, well, you really have discovered the philosophical stone, right? Because, let's say that it's a handful of probabilities. Maybe you have 3, 4 probabilities. Sure. But now you have reduced all the let's say the odds that you know exactly where you're going to go wrong. And so now you have a bunch of rules and guidelines that tell you exactly where you're going to go wrong. You're not going to be guessing at all. And so, that takes me to probably the last thing I want to share with you today, which is, are counts final? Well, no, they cannot be. Because again, we don't have a crystal ball. So we can have a count that we believe is the correct count. But there are other counts that are possible. Sometimes, not all the time, but often there are alternate counts. Many people complain that we have alternate counts. But alternate counts are the biggest blessing that we can have, because it's precisely those alternate counts that tell us when we are going to be right and when we're going to be wrong. And very, very clearly, we are not going to be there hoping ever as an Elliottian. You're never, ever hoping. you are always knowing where either this count perform or that count perform. And then many people, well, the vast majority of traders who don't know Elliott wave, they object precisely that, and they accuse us. They say, you guys are never wrong because you can always relabel the waves. Every time the market proves your count incorrect, and you just relabel it. And then they say, well, that only describes history, but you cannot predict anything. Well, that's absolutely silly. I mean, this is tantamount to saying, well, yes, I made a mistake in my count. I made a mistake in my interpretation. Now I should not fix it. I should stay with that and, I don't know, stay there until I die. That's another asininity. It cannot be anything else but an asininity. You know, if you make a mistake in your interpretation, the Elliott wave is not going to be wrong. I mean, it's like Elliott wave is like a tool. You have a hammer, okay? And you're going to build a table with that hammer. Now you really hammered it strongly and you broke the table, okay? Now you blame the hammer. Well, no, the hammer is what you needed to build a table. But it was the user of the hammer, the one that used the hammer in the wrong way. So when you make an interpretation that is incorrect, that happens. It happens to all of us and will always happen because we don't know the future. We can only interpret what we see in front of us. And so this is one of the greatest blessings that we have, which is we have different counts. And you could see, probably I could show you, why don't we do that? You asked me for Bitcoin, so I'm not going to forget that. And let me go to Bitcoin, and then I can give you probably there I have different counts, because typically I will have different counts on my charts. Why? Well, because no count is the definite one ever. Okay, so let's see. No, let me change charts. Oh no, this is the chart. It should be this one. Well, let me move to the monthly chart. We start from there. All right. So here we have. Okay, I'm going to get rid of this moving average. Yeah, you can see, you got me. You see, I use moving average too, of course. All right, so there you have. This is the monthly. I'm sorry, let me read your comments first. Professor knows all the hate and critique against Elliott wave. Well, I've been doing this for decades. I have heard it all. And they always make me laugh. They always make me smile, because every time that people tell me one of those objections, I call them objections, it's because they don't know the Elliott wave. You never, ever, I have been, believe me, I've been doing this for decades, and I have never, ever encountered anyone who actually understands the wave principle properly and gives any of those silly objections. So it's typically for people that didn't understand it or understood it but tried to learn them by themselves. And then, of course, it's difficult. It's difficult to learn by yourself and try to apply it all by yourself. Let's see. As you said, most traders hope. And with my experience, hope is a losing trade. Indeed, when you find yourself hoping, you'd better get out of that trade, because hoping is a very bad emotion. People talk about greed and fear, but hope really is a very damaging emotion in your psychology. I make the labeling mistakes, so how can get it right more? Everything is in real time. Yes, everything is in real time, but you are not trading every leg. Let's give you an example with the the chart we have in front of us, or with the Etsy chart that we have seen many times. You are planning that. Yeah, you may be making a mistake in the count. You thought that it was going to be a wave 2, and it wasn't a wave 2. Well, you planned to go there, let's say at the 62%, and now you realize that the correction wasn't in 3. It developed in 5. Well, you're not going to enter if you saw something developing in 5. Why? Well, because if it's developing in 5, that means that the trend is still not complete, right? So it's going to continue in the opposite direction. Calling out all the smoke, naysayers say repeatedly. Well, no, it's really not my intention to do it as a criticism for the people that don't understand Elliott wave, but it is for your benefit to know that all those things are absolutely useless. Okay, go back to this chart. What is wrong with this chart? Can anybody tell me what is wrong with this chart? I mean, from everything you've learned so far, would you say that this is wave 1, 2, 3, 4, and 5 developing into 5? 1, 2, 3, 4, and 5. So very close to ending, right? Ending the wave 1 of something much larger. Now, do you see anything wrong here? Let me give you a moment. Nobody tells me what's wrong. Well, I tell you what's wrong. Wave 3 looks the shortest. Look at this wave 5. Look at this wave 1. Wave 3 doesn't look to be larger than the others. But that's because this chart is using a logarithmic scale. And so if you measure from here to this is 2 to 1 is 1,000, right? But from here to here, well, that distance goes from 100 to 19,000. So which one is larger? Obviously this one is larger, right? But that's because I'm using a logarithmic scale here, and that's the reason why my chart is still like that. Third looks smaller. Thank you. I'm so glad that you noticed. Exactly. But now we know this is deceiving, right? It looks smaller, but it isn't, because you know that what you are doing here is moving from 2 to 1,000, whereas here you're moving from 100 to 19,000. So this move is a lot bigger. Okay, so now we know here we are expecting something like 1, 2, 3, 4, and now we're expecting a wave 5 to end pretty soon. Now we need to concentrate on this move here, right? On this 5th wave, and see if this 5th wave has developed already into 5. So in order to do that, what do? Well, we move to a smaller time frame. This is a monthly chart. Oops. This is a monthly chart. So now let's go to a weekly and see if we can spot better that wave 5. So we have here the wave 4. And now we can see what we're expecting. We have 5 waves here for wave 1. Can you see? 1, 2, 3, 4, 5, wave 1. ABC for wave 2. Very clearly, it's a flat, as you can see. And now we have 1, 2, 3, 4, 5 for wave 3. And here, what are we expecting? We're expecting an ABC down for wave 4, ideally to go to this trend line. And then another leg up. All right, so when I say that this is ready to finish the entire cycle of all the 5 waves in a monthly chart, I don't mean this is going to collapse tomorrow. This is going to, all the subdivisions must be there. And so far, we are seeing the subdivisions with a certain degree of clarity. Okay, so now let's move to a smaller time frame. We can go to a daily chart here, or even a 6-hour chart would probably suffice. If we go here, we can see what is happening here. and we expect, you can see that, well, actually, I shared this chart with you before. I had 1, 2, 3, 4, 5 for an A here, a B, and I'm expecting 1, 2, 3, 4, 5 still to develop to the downside. It hasn't happened yet. So we are using this level here as critical resistance. What does it mean? Well, if prices go above here, then I will have to consider that wave 3 was either a truncation that couldn't come below here, or that wave 3 was complete here, or that we have a 1, 2, 1, 2. But until I have this level here penetrated, I won't be able to decide whether this is a wave 2 or a wave 4. So far, I am seeing it as a corrective wave that will eventually prove corrective, and the trend will continue down. Why? Well, because if you remember on the smaller time frame, this is what we're expecting, a WXY down and then an X, and probably, I'm sorry, I didn't tell you what WXY was. Don't worry about that. That means a double zigzag. Remember when I explained the double zigzags, when we have an X, well, sometimes the ABC are called W's. Now, why didn't I tell you this? Well, for one important reason. One, because it's very confusing when you add new terminology for something that doesn't really require it. And two, because Elliott himself never used W's, X, and Y's. He used A, B, C, D, X, A, B, C, D, X, A, B, C, D. And that's the reason why I did not include the W's, X, and Y's. And by the way, look at here. We have a beautiful ending diagonal. See, 1, 2, 3, 4, 5. And yeah, so we are expecting prices to continue moving lower here. I don't know if this is what you wanted to see, but well, you requested the Bitcoin and I show you. So in the log chart, Elliott rules to be applied with care. No, in the log chart, Elliott rules should be applied exactly as they are. But you must be careful that you measure things properly. Okay, so in the log chart, well, let me put it this way. The distances, let's say that this is the scale, okay? So you are, let's say that this is the scale here. Here you are born. Now you are 1 year old. Now you are 2 years old. Okay, now you are 3 years old. Now 4 years old. Now all these distances are equal, right? But from here to here, from 0 to 1, or from 1 to 2, it actually double. So from 2 to 3, it shouldn't be the same distance as when it doubles. It's not the same to say, well, from 1 to 2, it's the same as from 10 to 20, or from 50 to 100, or from 100 to 200. Can we say that 1 to 2 is the same distance as 1 to 100? No, if we were using a correct distance, we would see that, well, from 1 to 2 may be here, but from 100 to 200 may be here. Right? The distances are completely different. So what you have to do is to be aware of those distances, right? But apply the rules of Elliott exactly as they are intended. The rules of Elliott are really they are inviolable. They are like laws. Okay, so you always have to be very, very strict with them. You will find that some people say, well, when you trade futures, you can be flexible and allowing things that you cannot allow when you are not trading futures, but you're trading stocks or indices or whatever. I would warn you against that. And the reason is, yes, futures have a lot of leverage, but at the same time, the moment that you make a rule flexible, you stop knowing where are the limits. And so if, because we're trading futures and we say, well, this is 1, 2, 3, 4, well, it did a little bit, but we know it's future, so let's allow it. The moment that you allow this, you don't know if this is indeed a wave 1 or if this is a correction A, B, C, and X, and another A, B, C. You don't know what this is anymore because you cannot rely on something that you have given that flexibility. Okay, I'm glad you mentioned the log scale. What criteria do you adhere to on when to use logs? Well, whenever the prices change substantially, maybe more than, let's say, 5% or something like that, then you should apply a log scale, because if you don't, well, you'll see the consequences. Let me put it this way. Let me give you an example. Let's use the chart that we have been using all this time, okay? Let's use the Etsy chart. Okay, we have been using this chart over and over and over again. Well, I'm going to show you this chart on a arithmetic scale. In an arithmetic scale, well, you can hardly label this properly. You cannot see 5 legs here or here or here. Look at this tremendous movement there. But the moment that you use the logarithmic chart, then of course everything becomes normal. Okay, so when you go to the arithmetic chart, then, well, the distance from here, look, it started, let's say, at 5 or something, and it went all the way to 300. Well, when the distances are that huge, you need to use a logarithmic chart. It's not possible otherwise. You cannot really label this. No, not possible. You need to have the proper chart to label it. Okay, so is it Elliott double combo? I don't know what Elliott double combo is, or what do you mean by that? Thank you for reviewing BTC. I'm glad that suit what you needed. Okay, I believe we went today very, very, very long. I think since this is the last session that we're going to have, I am willing to answer any question you may have, but I think I'm going to give you an example, make an example of labeling a chart for you, and to show you what am I thinking, how you should think on this, and maybe and what am I expecting there, etc. So you can have some ideas, okay? As usual, well, here, this is very interesting. Don't know if we should label this chart, but this is beautiful. Look at this. What we see here and what we see here. Isn't this very similar to this drawing that I keep making? And then now, down, up, down. Isn't this the same thing? The 8-wave cycle? Can you possibly see it there? Your accent looks Hispanic. Where are you from? Yes, this is a very difficult question. I think I lost track. Where am I from? Because I am from many places. I lived many years in Canada. I lived many years in the US. I lived many years in South America. I lived many years in Spain. And I have lived in Germany for 35 plus years. So, yes, my accent takes whatever shape. All right, so I think it's very clear what I show you there. 1, 2, 3, 4, 5. And then here, A, B, C, remember that double zigzag that we spoke about? A, B, C for the first zigzag, and then X, and now A, B, expecting a C, right? And now we can say, well, where is this going to go? Well, it's going to end soon because this already penetrated the 62%. But remember something that I didn't mention. How are you going to remember if I didn't mention it? if it didn't go to the 62%, likely it's going to tackle the next Fibonacci ratio, which is the 78%, right? So you would expect probably that prices are going to stop around here. Or if this is not the case, let's say that we know something about zigzags. We know that they tend to equality, meaning that this first zigzag that we saw here will probably be equal to this next zigzag. And look how this next zigzag achieves equality very close to the 78%. So we know what to expect. Something like 350 or something like that. This is a good price that we could use to enter this stock, right? Okay, so let me not use this stock. I think I'm going to use another one, probably easier for me to explain. Let me use this ABTC because it's a simple thing. Yes, I've been traveling quite a bit. I've been traveling quite a bit in my life. All right, so what do you think? Does it look corrective? Let's remember something. Let's remember the personality. Personality of impulses versus corrections. Well, we know that impulses tend to be fast, thin, elegant. They don't have overlaps. Pretty much everything we see there, right? Whereas corrections tend to be choppy, sloppy, slow, fat. And this is not it. So I would say this looks like a very, very heavy decline. So I would be let's say, inspired to label it as a, well, down here as a 1, let's say. Maybe a 2 here, let's see. A, B, C, maybe a 2 here. And then we get, look at this decline. Boom, and stop, right? Maybe a 3 there, 4, and now we have 1, 2, 3, 4, 5, 4, 5, right? Let's change the degree of this. And if you are not following me, let me know so I repeat my thought process. And then now we can label the internals of this leg that look like the extended one. And remember the Aldo's guideline, it says that the leg that shows the extension should be able to show the internals, right? So let's change the degree of this to intermediate. And then we put the 1, the first decline, obviously. Not much to be looking for, right? The 2 in the opposite direction. The 3, very obvious. The 4, also very obvious. And the 5th, well, at the bottom, right? I think you all agree that this makes sense, wouldn't you? Let's see, if we mark up an impulse wave and find out that it has been broken, do you adjust the marking to fit the rules, or do you ignore that wave altogether and look for the wave pattern somewhere else? Well, that really depends on you, no? That's up to you. Often, personally, if I don't see something very, very clear, I say this is not a moment to trade. For instance, today I told my students, participants on the trading mastery program, I showed them this chart, right, and said, do not trade until this sorts itself out. Why? Let's see. Let me show you this. And so sometimes the waves are not clear there. So what do? Until they become clear, you don't want to be part of that. So let's make it smaller so you can see better. So it looks like an A, an A, B, C, potentially D and E, right? This should be moved here. But we don't know if this is going to be the correct interpretation. Maybe it's not. Maybe this is going to go out, up, and break this high here. Maybe. If it doesn't, maybe it doesn't go here and doesn't break this, and then we are going to have, we will have, the triangle will have more credence, and we will more confident on taking a position if we see the E, and then we'll trade then, right? But if the thing is not obvious there, we identify this as a very sideways market, isn't it? And so how do we know it's going to be a sideways market? Well, obviously it's a correction, it's a B, right? We have here as an A, now we're expecting a B, so it's going to be a correction. And if we're wrong and this is a 1, well, this is going to be a 2, you know, so it's going to be a correction. So this is not the place where you want to be a participant. I hope it makes sense. Now I forgot what stock was I labeling. Let's see, I think it was ABTC. Just not this chart, I think it was this chart. Right, so now we have these 5 waves. Here we're assuming that it ended, and this move looks very thin, very fast, very vertical. It looks to me that probably there are 5 waves there. Can we see that there in the monthly chart? No, we cannot. Now, can this help us to take a decision to buy this stock? Of course, it can. Why? Well, for several reasons. The series of lows and higher lows have been broken to begin with. You see this one? It was broken. So now there is not a series of lower lows and lower highs. So this is not a downtrend any longer, right? If we put a trend line there, probably the trend line was broken as well. So nothing defines this as a downtrend any longer because the 5 waves are already visible, arguably correct. So now we can move to a smaller time frame and check if this can give us an opportunity. So let's go to the weekly chart. And I hope this actually answers the questions of those who were asking for dual time frames or what time frame is best. Okay, here we can easily see that this move can be 5 waves. You can see 1 stop there, 2 stop here, 3 stop there, 4 and 5. Very easily can be countable as a 5-wave move with the 5th wave extended. And now we have an A, B and C. Do you remember that shape? It was like this one to the origin of wave A. It seems like, it looks like one of the drawings that we drew early, right? A flat. So if it is a flat, we expect it to come below here. So using a little bit more of our technical analysis knowledge, we say maybe it's going to go below here, probably to close this gap, right? And if that coincides with the percentages that we expect for a wave 2 retracement, so we have here, well, guess what? This is the 50% and the 60%. So right here, this is the area where we want to buy. That's why I typically do this. Actually, I can show you this in my charts. So you can see that we expect prices to come here, close the gap, be in the buying area, and from there, well, from there we can buy this stock with the expectations that, given the fact that this is very impulsive and this is very corrective, we should define the trend now as up, right? And as a very minimum, we're going to see another move to the upside, which is going to be very, very rewarding because it would go percentage-wise from very low price, like 2, 3 or something, all the way, I mean, equal to this, that would be all the way to 30 something, right? So Now you can go to the daily chart and look for the subdivisions of this, and look, it looks like we have A, B, and now we have 1, 2, 3, 4, 5. So you can see how now you start putting it together. Then you need to find the fifth wave here. Well, then you move to a 4 hour or whatever. If we don't see it there, it looks like it's possible to see it there. But if we don't, then we move for a 2 hour or a 500 minute. Look at here in 2 hours, looks much clearer, right? So that's the way we use it. And I wanted to give you this example so you can see a practical approach and to where we're going to decide to buy that stock. Okay. All right. Okay, guys. So I think now I can answer any question if you are still with me, and you have any question, please. This is the moment. Otherwise, we won't be able to discuss anymore. If you want to know how I can help you, just arrange, schedule a call where we can discuss how, if you like the wave principle, if you like the way that I work and you want to work with me, then please arrange a call, and either one of the members of my team or even myself can speak and tell you everything about it. Okay, since I don't see more questions coming in, I'm going to say good night. Have a wonderful weekend, and I hope that you enjoy the entire week of Elliott Wave Intensive. Thank you so much, and talk to you soon. Bye-bye.